Hey everyone, this is Michael Ben-Giat, and this is the Market Trend Advisory Weekend Report for April 16th, 2022. I hope you're all having a great long weekend, and I'm shooting this on Saturday. And before we start, this is our disclaimer. You can pause the video and take a look at this and make sure you understand it. Okay, well, let's go ahead and just get started right into the market trend. So the Nasdaq, as we've seen this week, we moved into a downtrend and a correction. We currently have no exposure. Market count 0. The market exposure is 0. And individual stocks and non-indexed ETFs, we're down about 10% or so. The market is really not acting well on any counts. We have a lot more institutional selling days that have been happening, and they're starting to cluster, which is giving us sell signals. The S&P was hanging in there until Thursday, and at the close, we actually now have a market count of 0, just like the Nasdaq, and a market exposure of 0%. And we're still an uptrend under pressure, uptrend uncertain, just because it's holding up a little bit better because of the energy stocks and cyclicals and commodity stocks that are in the S&P. That's kind of holding it up a little bit better than the Nasdaq, which doesn't really have those sectors in there. But it's not looking good, and we're now down to 0 exposure in both indexes. So for our investing strategies, nothing to do with the QQQ one. We're already out. But on Monday morning, following the market count 2x strategy, you're going to reduce your exposure from 55% down to 0 at the open. And because these strategies are trend following, we just haven't been getting very good performance overall. But we've been, in the Nasdaq, we've basically been slightly better than the QQQ for the 2X, which is really good considering this is double leverage. I've also been saying too that whenever there's a down year or the index is going negative, you would avoid the 3X version of it altogether. It's really much more suited for when we have strong uptrends. So we're tracking it anyways, but you'd be down almost 22%, which is not really acceptable. But we just stay out of that one. The other one, it very quickly, when the market turns, these things go up back pretty quickly into positive territory. And for the S&P, moves a little bit slower. We have a little bit worse performance, but not bad for considering it's a double leverage. Okay, so let's take a little bit closer look at the Nasdaq and the S&P. So we can see here we have been getting a lot of volatility. The market is just struggling to determine what it wants to do. We've had 3 days here of, I think it's more than 2% moves up and down. And it's like one day up, one day down, next day up, next one day down. This is bearish action, even though we're not really getting much higher volume, but we're getting enough that it's triggering some of these sell signals on distribution. And going back to the S&P, one reason it knocked it down so much is that we actually had 2 consecutive distribution clusters, which means we're getting a lot of distribution days in a short 8-period rolling period. So that's been knocking that down. So going back to the Nasdaq, it does look like we're going to test the lows. That would not be surprising. Whether or not we break it and head lower, nobody knows at this point. But it's not acting well, and for various reasons we'll show you in terms of interest rates and other things continue higher. So that's the weaker of the indexes. The S&P is holding up a little better, even though it did close below its 50-day, and that is the red line here. And the 50-day is now rolled over, which is now it's pointing down, which is a little bit of a negative sign too. But overall, this is holding up better just because it's S&P 500 contains a lot more energy stocks, commodity stocks, cyclicals. And this may even hold up a little bit better as, the indexes are always changing the components. And energy, I think in one point was down just under 5% of the S&P. But probably they'll start knocking out some tech stocks, and we'll start putting back energy. That's how they do it in the indexes to make them look stronger. So we'll see what happens there, but it wouldn't surprise me if the market just continues lower. Now, one thing that's been coming up, and this makes it also difficult when you're trying to see, well, I'll short the market or not, is that we're getting the sentiment is starting to be very, very bearish, which is surprising because we're not really down very much on the indexes. I mean, the Nasdaq did hit a bear market, but rocketed out of there, came back more than half of that, even though we're kind of rolling back over. So this sentiment from AAII survey was, they asked the constituents, what do you think what's going to happen to the market, 6 months from now? And we're getting the lowest optimism in over 30 years. The bulls were down to 16%, and the bears were almost 50%. So to have this much bearishness is a little surprising, considering we're not really down along, and we're not like this bear market has dragged on for months and months and years like you would. So I would normally expect to see these kind of numbers, at like the bottom in 2008, late 2008, late 2002, when we've had much more protracted bear markets. So very interesting that it's really just plunged so much. And the reason why these contrary indicators work is that when you get down here, we have this few bulls. It just means that you have most of the bears have already sold, and there's not a lot of people left to sell because they're already bearish and they've exited the market, giving it fuel for, okay, well, the sellers are gone, the buyers can come back in and buy. And the same thing on the top, when there's too many bulls, everybody wants to be in the market, has already put all their money in, and there's not a lot of buying power left to keep pushing it higher and higher and higher, so the market tends to revert. So that's the contrary view of how to use the sentiment. So this is a little bit surprising here that we've gone this negative this quickly, but this market has been full of surprises for the last 2 years. So, and of course during the coronavirus crash, I mean we got down so negative in just less than a month that I think our CNN indicator went down to 1, which was like extreme panic. And I think then after, when the big rally, we were, I think, at 90%, which was like, super greed and excessive optimism. So let's move on to, we talked about this last week. These are the interest rates. What the market doesn't like is that, this is the 10-year note, is that it's just rocketing higher. The market doesn't mind interest rates that are creeping up higher, because it just has the chance to work through the system. But the fact that it's shooting up higher and higher, and here's also the 5-year note, we're back to where we were in 2019. So it's already wiped out the interest rate cuts and the interest rate drop that happened in 2020, and we're just rocketing back. I mean, this is already a 700% move just in terms of the yield. So this quick of a move, this quickly, is showing that to the market that the Fed is behind the curve and is going to probably have to jack up interest rates much quicker and much stronger than people are expecting, especially because inflation just doesn't seem to stop. Even though, the slightest little move down an inch, and I think it was on Wednesday, the numbers came in slightly better than expected, and we had a big rally. Sometimes, Wall Street, it's like children. They just overreact to the slightest little things. So, anyways, that's what these charts are telling the market, and so it doesn't like the fact. So, especially for the Nasdaq, which has a lot more tech companies, which are more interest rate sensitive in terms of their performance of their stocks, and so the market's not liking what it's seeing. So one thing I want to do a quick little talk about. Every so often I bring this up. But we did have, on top of all the other recession signals we're getting, inverted yield curve and all that, is that we have the Dow Jones Transportation Average has entered a bear market territory recently. So why is this important? There's a field of study called Dow theory. And what that means is that when the best way to explain it is, the market is healthy and in the bull market if the Dow Jones Industrial Average and the Dow Jones Transportation Average are both working together. They're both hitting highs together, and or they're close to hitting highs together. And the reason that this has been a powerful signal at times is that the Dow Jones Industrials represent all the production of, the big companies are producing all the goods. And the transportation's average is representing the transportation companies that are shipping those goods. So you're kind of getting when they're working together, you have a balance of supply and demand. When one of them's acting, much worse or weaker than the other, then there's issues in the economy at large, and leading on to what's happening. So sometimes this is considered sort of a leading indicator of what's going on. So there is one key thing to know when you kind of look at this from Dow theory, is that having this divergence, especially having the Dow Jones Transportation Index lower than the Dow, is that it's a necessary condition, but it's not the only condition. So it doesn't guarantee that there's going to be a major top in the Dow Industrials, but a major market top in the Dow Industrials has never occurred without the absence of underperformance in the transports. So so I never explained the chart here. It's a little bit small. This is the Dow Jones Industrial, and you can see we're not too far off of the all-time highs, which was over here in January. But the Dow Jones Transportation had a very strange day. I forget, something happened here. We had a massive move up, and then it just collapsed, and then we've broken down. So you can see, just eyeballing it, that we're much weaker in the transportation index. Real quickly, I'm just going to bring up a couple charts here. Give me a second. So I think we can see this, yeah. So there's a couple things that we've been noticing, like the trucking industry suddenly has collapsed. This is J.B. Hunt, and one of the major trucking companies. You can see the chart there, and just recently, stock tried to break out, looked very bullish, and just plunged. That's a little bit of a warning there. Another one is FedEx. That's ticker FDX. Again, really, let's look at a weekly chart. This has just been it's in a bear market. I mean, we're making new lows. We're trending below all the moving averages. In fact, we can't even really get even above the 50. Sorry, this is the 10-week, because we're in a weekly chart. Another one is XPO, another big transportation logistics company. And again, look at this. That's bear market action going on. And if we go to a daily, yeah, it tried to rally. You can see this is what happens in bear markets. We sometimes try to get up to the 200-day, which is this black line, which is declining. And we had one day, it tried to get above there, closed right at it, and then the sellers just piled in. And we've had 1, 2, 3, 4, 5, 6, I mean, I don't even know how many days. Looks like 12, 13 days in a row of selling, and culminating this last day of really high volume. So this is telling us there's something that side of the market, the transportation of goods, is not healthy. So anyways, that's something we sometimes look at as Dow theory, and it's kind of corroborating the rest of the story of the market is not acting well and probably will head lower in the future. And the last thing I want to talk about is something that's maybe it's sometimes powerful and it seems to work sometimes, but it's nothing that you're going to go, okay, I'm going to trade up upon this information. But we've entered the sell in May and go away period, which is looking, well, we're not quite in May yet, but we're getting closer, and the market's already kind of struggling where it is. But the May to November stretch before a midterm election has historically been the weakest 6-month period in the presidential cycle. So this phrase, you've all heard it, and it does sound like it's something from the Farmer's Almanac. But if you look back to 1926, the S&P 500 has only averaged 2.2% during this period in the second year of a presidency. So that made it the worst half year for stocks. In contrast, if you go to the November-April period, which is goes into the third year of a presidential term, we were getting the best returns, 13.9%. So again, nothing you're going to really trade off of this kind of a seasonal aspect to the market. But combined with the rest of the things that are happening, we might be better off selling May and go away. We've already sold in our system, and we're out already. Whether this lasts until May and beyond, we don't know. Probably we're going to get another, ear-ripping bear market rally off the bottom at some point. That's just what the market does. So anyways, at this point, we're basically out of the market, and we will just see what happens next week. It's overall, as we've seen, it's all looking pretty weak seasonally in terms of everything else. Dow theory is giving us the same story. The markets do look like they're probably going to test the lows. And again, we will just trade by what the what our system tells us to do. And right now we're out, but it's not the time to be like, okay, we're out, let's just go on vacation. These markets change on a dime, as we've all seen, and we'll be looking forward to the next uptrend. Okay, thanks a lot. I'll talk to you next weekend. Thanks. Bye.